Trading is often seen as a mysterious world. People imagine a room full of flashing screens, loud voices, and sudden fortunes made or lost in seconds. But behind the noise, the true story of trading is far more subtle. It is about discipline, psychology, risk, and the ability to think differently. In Hedge Fund Market Wizards, Jack D. Schwager takes us inside the minds of some of the most successful hedge fund managers in the world. These are not ordinary investors. They are the ones who consistently delivered extraordinary results while facing the same unpredictable markets that crush most participants. What makes them different is not a single magic formula. It is their mindset. It is the way they deal with uncertainty, mistakes, and opportunities. Schwager does not present these traders as superhuman geniuses. Instead, he shows them as learners. They make mistakes. They take losses. But unlike most people, they treat every mistake as a lesson. They adapt. They survive. And over time, they thrive. This book is divided into several parts, each highlighting a different style of trading. Some traders bet on global macroeconomic events. Others run multi-strategy funds with advanced mathematics. Some are equity specialists or commodity experts. And one is even a master salesman who built a business around hedge funds. Despite their differences, the lessons they share echo the same themes: risk management, discipline, adaptability, and the courage to think independently. The journey begins with Part 1, Macro Men, where we meet traders who look at the big picture. They study economies, interest rates, currencies, and global events to make their bets. These are the men who ask questions like, is the world economy growing or shrinking? Where is the money flowing? Which countries are rising and which are falling? They trade not just companies, but entire nations. Let us step into their world and see how they turn shifting global weather into opportunity. Part 1. Macro Men. Every trader has a unique way of looking at markets. Some focus on individual companies. Some depend on mathematics and models. But macro traders think bigger. They watch entire economies. They study governments, central banks, currencies, and global money flows. For them, the market is like a living weather system. Shifts in interest rates can feel like storms. Political events can shake economies like earthquakes. And sudden financial crises can flood markets in unexpected ways. Macro traders try to make sense of this chaos. They ask, where is the wind blowing? Where is the rain falling? And how can we position ourselves before the next storm arrives? The traders in this part of the book show us that success is not about predicting the future with perfect accuracy. It is about recognizing what is happening right now. It is about humility, flexibility, and the courage to act when conditions change. And this brings us to our first story. The journey begins with Colm O'Shea, a trader who believed that the market is like the weather. You cannot control it. You cannot argue with it. But you can observe it. And if you pay close attention, you will know when it is raining. Chapter 1. Colm O'Shea, Knowing When It's Raining. Colm O'Shea is one of those traders who prove that success in markets is not about always being right, but about knowing when you are wrong. He started his career with a curiosity about how economies worked. He was fascinated by the way currencies moved, how central banks influenced markets, and how political events created waves across the world of finance. Over the years, he developed a trading philosophy that was less about prediction and more about observation. O'Shea compared the market to the weather. No one can predict exactly when it will rain or how heavy the storm will be. But if you look up at the sky, you can see the dark clouds forming. You can feel the wind shifting. And if you are paying attention, you know it is time to carry an umbrella. In the same way, he believed that traders must look at what is happening in front of them, not what they wish to happen. He explained that too many traders fall in love with their ideas. They build stories in their heads and then refuse to let go, even when the market is screaming the opposite. For O'Shea, ego was the real enemy. The market is never wrong. The only thing that can be wrong is your position. This is why he insisted on humility. A trader must accept being wrong quickly, cut the loss, and move on. One of his strongest lessons was intellectual flexibility. He told Schwager that a great trader is not someone who can predict the future, but someone who can constantly adapt to the present. If you are stubborn, you will eventually break. But if you are flexible, you can bend and survive. He described trading as a process of continuous learning. Every trade is a lesson, every mistake is feedback, and every market shift is an opportunity to reset. Another important part of his style was risk management. O'Shea said that trading is a business of survival. If you lose all your capital, the game is over. So he always focused on cutting losses early. He never believed in hoping that a bad trade would come back. Hope, he said, is not a strategy. Discipline is. If the clouds were already raining, there was no point pretending the sun was still shining. He also emphasized that patience is just as important as action. Sometimes the right move is to stay on the sidelines and wait. He explained that being in the market all the time creates unnecessary risks. The best trades are obvious only when conditions line up. When you see the clouds, when you feel the rain, that is the moment to act decisively. Until then, patience protects you. What made O'Shea unique was his ability to detach his identity from his trades. He never saw being wrong as a personal failure. Instead, he saw it as information. If the market moved against him, it was telling him something he had missed. Rather than fighting, he listened. And by listening, he improved. His story reminds us that trading is not about genius-level predictions. It is about awareness. It is about respecting reality. It is about noticing when it is raining, even if your forecast said sunny skies. This attitude allowed O'Shea to survive and thrive in a world where most traders eventually burn out. And so, from Column O'Shea, we learn the importance of humility, flexibility, and the courage to admit when the market has changed. But while O'Shea taught us the value of observing the present, the next trader takes us into another dimension of wisdom. Ray Dalio, one of the greatest hedge fund managers of all time, built an empire on learning from mistakes. Where O'Shea focused on recognizing when it is raining, Dalio went deeper into understanding why storms happen at all. His philosophy was simple yet powerful. Every mistake hides a lesson, and every lesson can build a better system for tomorrow. Let us now step into Chapter 2 and meet Ray Dalio, the man who loves mistakes. Chapter 2. Ray Dalio, the man who loves mistakes. Ray Dalio is not just a hedge fund manager. He is the founder of Bridgewater Associates, one of the largest and most influential investment firms in the world. But what makes him stand out is not only his financial success, it is his philosophy of radical learning. Dalio is a man who sees mistakes not as failures, but as gifts. He believes that every mistake carries a lesson, and if you pay attention to that lesson, you grow stronger. Dalio's career began with the same uncertainty as every trader's journey. He faced losses, he faced humiliation, and he faced moments where he thought it was all over. But instead of hiding from those painful experiences, he studied them. He asked himself, why did this go wrong? What could I have done differently? How do I prevent this from happening again? Each mistake became a stepping stone. Over time, this habit built a culture of constant improvement, both for him and for his firm. At Bridgewater, Dalio introduced a culture of radical transparency. This meant that every employee was free to question anyone, including Dalio himself. If someone made an error, it was openly discussed, not hidden. The goal was not to blame, but to understand. By shining a light on weaknesses, the company made itself stronger. Dalio explained that the biggest danger in trading is not being wrong, but refusing to admit that you are wrong. By embracing mistakes, you face reality faster, and the faster you face reality, the better your decisions become. Dalio also believed in building models of how the world works. He studied history, economies, and cause and effect relationships. Why do interest rates move? Why do currencies rise and fall? Why do markets crash? By analyzing these patterns and testing them against decades of data, he built systems that guided his trading. For Dalio, knowledge was like a map. The more detailed the map, the easier it is to navigate the terrain of markets. But even with models, Dalio never allowed arrogance to take over. He repeated again and again that nobody knows everything. Reality is always more complex than we imagine. That is why mistakes are valuable. They reveal blind spots. They show us what we did not see. And once revealed, those blind spots can be corrected. Another core idea Dalio shared was about balance. He spoke of diversification not just as a financial tool, but as a way of thinking. A good portfolio is like a good life strategy. Do not rely on one path. Spread your risks. Prepare for different possibilities. Because the future is uncertain, the only way to survive is to build resilience. Dalio's story is inspiring because it shows that greatness does not come from never falling. It comes from falling and then using each fall as a teacher. He turned mistakes into principles, and those principles into a system that guided one of the most successful funds in history. For traders, his lesson is clear. Do not fear mistakes. Do not hide from them. Love them. Because inside every mistake is the seed of wisdom. If you learn the lesson, the mistake was never truly a loss. It was an investment in your future strength. From Colin O'Shea, we learned to look at markets as they are, like observing the weather. From Ray Dalio, we learned to look within ourselves, to treat every error as a gift that teaches us how to navigate storms more wisely. But the journey does not stop here. The next trader shows us a different kind of wisdom. Larry Benedict, a man who survived decades in the markets, built his career not on loving mistakes, but on avoiding disaster. He played the game with one principle: do not get knocked out. Let us now enter Chapter 3 and hear the lessons of Larry Benedict, a trader who went beyond 3 strikes. Chapter 3: Larry Benedict, Beyond 3 Strikes. Larry Benedict built his career as a trader not by chasing the biggest wins, but by making sure he stayed in the game. He knew that the most dangerous mistake in trading is not being wrong once. It is letting a single wrong trade grow so big that it wipes you out. For him, risk control was everything. In fact, he often said that trading is not about brilliance. It is about survival. Benedict started in the business like many others, with excitement and ambition. But over time, he discovered that the markets are ruthless. One bad decision can undo years of hard work. So he trained himself to think differently. Instead of asking, "How much money can I make?" he asked, "How much can I lose if I am wrong?" This small shift in mindset made all the difference. He explained that too many traders allow their egos to take control. They hold on to losing positions because they do not want to admit they are wrong. They keep hoping the market will turn in their favor. But hope is not a strategy. Benedict believed in the opposite approach. When a trade went against him, he got out fast. He never gave the market a chance to destroy his capital. He understood that he could always come back tomorrow and trade again, but only if he preserved his money today. One of his key philosophies was consistency. He was not looking for home runs or giant wins. He focused on hitting singles, making small but steady gains. Over time, those small gains added up to big results. He compared trading to baseball. Most people think the game is about hitting home runs. But the teams that win championships are the ones that play consistently, avoiding errors and capitalizing on every small opportunity. In trading, as in baseball, consistency beats flashy moments. Benedict's discipline also extended to his emotions. He knew that fear and greed are the enemies of traders. When fear takes over, people hesitate and miss opportunities. When greed takes over, people take reckless risks. His answer was discipline. He never let emotions decide his trades. He trusted his rules. He trusted his process. Another lesson Benedict taught was the importance of preparation. He did not wake up and randomly pick trades. He studied. He analyzed. He created plans for different scenarios. That way, when markets moved suddenly, he was ready to act without panic. He was like a pilot trained for turbulence. The storm did not scare him because he had rehearsed the response. What makes Benedict's story powerful is not one dramatic win, but his ability to survive decades in a brutal industry. He understood that the first rule of trading is to avoid getting knocked out. Because if you stay in the game long enough, opportunities will always come. If you lose everything, the game is over forever. From Benedict, we learn that success is not about being the smartest person in the room. It is about being disciplined enough to protect your capital, humble enough to admit mistakes quickly, and patient enough to let small wins accumulate into lasting wealth. We have now heard from Colm O'Shea, who taught us to observe the present like weather, from Ray Dalio, who showed us how to turn mistakes into lessons, and from Larry Benedict, who reminded us that the secret is not avoiding losses, but avoiding disaster. Next, we meet a man who took this quiet philosophy of discipline even further. Scott Ramsey, a low-profile trader who proved that you do not need fame or attention to deliver outstanding returns. Let us now step into Chapter 4 and uncover how Scott Ramsey built a career of high returns while staying in the shadows. Chapter 4. Scott Ramsey, Low Profile, High Return. Scott Ramsey is a trader who quietly built exceptional success without seeking fame or attention. In a world where Wall Street often celebrates flashy personalities and bold headlines, Ramsey's approach was the opposite. He believed that trading was not about being noticed, it was about results. And he achieved those results by focusing on patience, discipline, and careful observation. Ramsey's philosophy was simple. Do not force trades. Do not chase the market. Instead, wait for the right opportunities and act decisively when they appear. He compared trading to fishing. You cannot pull fish out of the water all the time. You must wait until the right moment, cast your line carefully, and then strike at the perfect time. For Ramsey, patience was as valuable as intelligence. He also emphasized humility. Many traders let ego dictate their decisions, seeking recognition or the thrill of risk. Ramsey avoided this trap. He kept a low profile, worked quietly, and let his returns speak for themselves. By staying under the radar, he avoided the distractions that often lead to poor decisions. He was not competing for attention. He was competing against the market, and the market does not care about anyone's ego. Another cornerstone of Ramsey's success was risk control. He knew that the first rule of trading is survival. Even a brilliant trade can be ruined by poor risk management. So he set strict rules for losses. If a position moved against him beyond a certain point, he would exit immediately. No hope. No wishful thinking. Discipline first. Profit second. Ramsey also focused on continuous learning. He observed patterns, noted mistakes, and adjusted his strategies over time. He believed that markets are always evolving. What works today may fail tomorrow. A trader who is adaptable will survive. A trader who is rigid will be left behind. He used both quantitative analysis and intuition to guide decisions, balancing numbers with judgment. Interestingly, Ramsey avoided overcomplicating strategies. He believed that simplicity is often the best approach. By keeping things clear and understandable, he reduced the chance of mistakes. Complex systems can break. Simple systems can endure. This principle applied not only to trading methods, but also to his life. He structured his routines, his analysis, and his decision-making to be disciplined, repeatable, and manageable. What stands out about Ramsey is the combination of high performance and low visibility. He proved that you do not need a large personality to succeed in markets. Results are what matter. Quiet confidence, patience, and consistent application of proven principles create lasting success. From Scott Ramsey, we learn that success is not always about being the loudest or taking the boldest risks. Sometimes it is about being disciplined, patient, and smart enough to wait for the right moment. And just like Colm O'Shea taught us to notice the rain, Ray Dalio taught us to learn from mistakes, and Larry Benedict taught us to survive. Ramsey adds another layer. He shows the power of quiet perseverance and disciplined execution. The journey of macro traders continues with Geoffrey Woodruff. Unlike Ramsey, Woodruff combines science and art, blending systematic models with creativity to navigate markets. He demonstrates that trading is not only about rules or discipline, but also about innovation and adaptability. Let us now step into Chapter 5 and explore the insights of Geoffrey Woodruff, The Art of Science and the Science of Art. Chapter 5. Geoffrey Woodruff, The Art of Science and the Science of Art. Geoffrey Woodruff is a trader who perfectly blends two seemingly opposite approaches. He combines the precision of science with the intuition of art. Unlike purely systematic traders who rely only on numbers, or purely discretionary traders who rely only on instinct, Woodruff uses both to gain an edge in the markets. His story teaches that the best results often come from balancing logic with creativity. Woodruff's approach begins with data. He studies historical patterns, statistical relationships, and probabilities. He builds models that quantify risk and potential reward. These models help him identify opportunities that others might overlook, but he does not blindly follow them. He constantly tests assumptions, adjusts for changing conditions, and remains alert for signals that the numbers alone cannot explain. At the same time, Woodruff embraces the artistic side of trading. He observes subtle market behavior, sentiment, and patterns that defy conventional logic. He pays attention to the market's rhythm, the flow of money, and the reactions of other traders. This artistic perception allows him to adapt when the rules of the game change. He calls this the art of science and the science of art. It is the idea that numbers are important, but interpretation, intuition, and creativity are equally vital. One key lesson from Woodruff is the importance of constant innovation. Markets are never static. A strategy that works today may fail tomorrow. If a trader becomes complacent, the edge is lost. Woodruff constantly questions his models and looks for improvements. He treats each trade as an experiment. He collects data, observes outcomes, and learns continuously. Failure is not feared. It is analyzed. Success is repeated, but never taken for granted. Another principle is humility. Woodruff acknowledges that no model or insight is perfect. Markets are unpredictable and full of surprises. By staying humble, he remains open to learning and avoids overconfidence, which is often the downfall of even the most skilled traders. He believes that humility combined with intelligence creates resilience. Risk control is also central to his philosophy. No matter how brilliant a strategy appears, Woodruff always limits potential losses. He understands that capital preservation is the foundation of long-term success. Without protecting the downside, even the best ideas can lead to disaster. Woodruff's story also demonstrates the value of curiosity. He approaches trading as a lifelong learning process. Each trade is an opportunity to observe, test, and improve. This curiosity fuels both the scientific rigor and the creative insight that define his success. From observing Colin O'Shea, we learn to notice what is happening in the present. From Ray Dalio, we learn to love and learn from mistakes. From Larry Benedict, we learn to avoid disaster. From Scott Ramsey, we learned the power of patience and low-profile discipline. And from Jaffray Woodruff, we learn that trading is both a science and an art. As Part 1, Macro Men, comes to a close, we see a clear pattern. Macro trading demands awareness, humility, adaptability, and discipline. But the next part of the book introduces a new group of traders who operate differently. Part 2, Multi-Strategy Players, shows traders who combine multiple approaches, blending innovation, risk control, and diverse strategies to capture opportunity across markets. Let us now move from the big-picture macro perspective into the world of multi-strategy trading and meet the innovators who define this approach. Part 2, Multi-Strategy Players. While Part 1 introduced us to macro traders who analyze entire economies and global flows, Part 2 explores a different breed of traders. These are the multi-strategy players. They do not rely on a single style or a single approach. Instead, they combine multiple strategies, blending different markets, techniques, and insights to capture opportunities wherever they arise. Multi-strategy trading is complex. It requires intelligence, discipline, and above all, flexibility. These traders cannot afford rigidity because the market is never predictable. What works in one environment may fail in another. Success comes from constantly adapting, balancing, and optimizing multiple approaches. It is like conducting an orchestra. Each instrument represents a strategy. When played in harmony, the result is powerful. If one instrument is out of tune, the whole performance suffers. Another defining characteristic of multi-strategy players is innovation. They often push the boundaries of conventional trading, using mathematics, technology, or unique insight to gain an edge. They are not satisfied with repeating old formulas. They experiment, learn, and refine continuously. Mistakes are inevitable, but each mistake feeds the system, making it stronger. Risk management is central to their success. Because they operate across multiple strategies, each carrying its own potential reward and danger, they must control exposure carefully. They know that ignoring risks in even one area can undo gains in another. Discipline, constant monitoring, and a clear framework for managing risk are non-negotiable. The traders in this part also share a mindset of continuous learning. They study patterns, test hypotheses, and learn from both successes and failures. Curiosity fuels innovation, and innovation fuels performance. They approach markets as a combination of art, science, and strategy, blending intuition, analysis, and systematic execution. Our journey into multi-strategy trading begins with Edward Thorp. Thorp is known as a pioneer, someone who applied mathematical models not only to markets, but also to games like blackjack, proving that probability and skill can consistently generate advantage. He shows us that creativity, logic, and rigorous testing can transform a simple idea into a lasting edge. Let us now step into Chapter 6 and explore the world of Edward Thorp, the innovator who turned science into strategy. Chapter 6. Edward Thorp, the innovator. Edward Thorp is often called a pioneer in quantitative trading. Long before computers became standard in finance, Thorp was using mathematics to uncover edges in markets. He began not in stocks or bonds, but in games of chance. In blackjack, he realized that careful calculation and observation could tilt the odds in your favor. He developed strategies to win consistently, proving that skill and knowledge can overcome randomness. This insight became the foundation of his approach to markets. Thorp believed that markets, like games, follow patterns that can be studied and analyzed. He developed mathematical models to identify inefficiencies in prices. These models were rigorous, tested repeatedly, and applied with discipline. But Thorp's genius was not just in creating models, it was in understanding their limitations. He knew that no model is perfect. Markets evolve, human behavior changes, and probabilities are never guarantees. By respecting uncertainty, he avoided overconfidence and prepared for surprises. Another key lesson from Thorp is the power of experimentation. He tested his ideas repeatedly before risking capital. Small experiments allowed him to refine methods, eliminate errors, and increase confidence. Thorp approached trading like a scientist. Every hypothesis was tested. Every result was analyzed. Every failure was a lesson to improve. Risk management was central to Thorp's approach. He understood that capital is a trader's most valuable resource. Even the best idea can fail if losses are allowed to accumulate. He carefully controlled position sizes, limited exposure, and always had a plan for adverse scenarios. This discipline allowed him to survive when others failed, and to compound gains steadily over time. Thorp also emphasized adaptability. He constantly sought new opportunities, whether in options, stocks, or other instruments. He was never tied to one market or one method. By diversifying strategies and constantly innovating, he created multiple streams of edge. This flexibility is a hallmark of multi-strategy trading. Thorp's story teaches a profound lesson. Success is not about luck. It is about preparation, observation, experimentation, and disciplined execution. It is about combining intelligence with humility, creativity with rigor, and analysis with judgment. His innovations paved the way for modern quantitative and multi-strategy trading. From Thorp, we learn that brilliance in trading comes not from guessing the future, but from understanding probabilities, testing ideas, and managing risk. He shows that knowledge can be transformed into consistent advantage when applied systematically and creatively. Having studied the methods of Edward Thorp, we now turn to a modern multi-strategy trader who seeks asymmetric opportunities in markets. Jamie Mai takes the lessons of innovation, risk control, and flexibility even further, applying them to real-world investments with bold but calculated strategies. Let us now step into Chapter 7 and explore the insights of Jamie Mai, a trader who seeks asymmetry in every opportunity. Chapter 7. Jamie Mai. Seeking asymmetry. Jamie Mai is a trader who thrives on identifying asymmetry in the markets. For him, the ideal opportunity is one where the potential reward far exceeds the potential risk. He does not aim for small, predictable gains. Instead, he searches for trades where the upside is significant and the downside is limited. This mindset of asymmetry defines his investment philosophy and guides his decision-making. Mai's approach is both analytical and intuitive. He studies markets in depth, analyzing economic trends, corporate fundamentals, and market psychology. But he also listens to his instincts, honed over years of observing how investors behave under pressure. He understands that markets are driven not just by numbers, but by human behavior, fear, and greed. By combining rigorous analysis with keen observation, he identifies situations others might overlook. One of Mai's key lessons is patience. He does not act on every opportunity. Instead, he waits for conditions to align in his favor. This discipline prevents him from overtrading or taking unnecessary risks. When a high-probability, high-reward opportunity arises, he moves decisively. Otherwise, he remains on the sidelines, conserving capital and preserving optionality. Risk management is central to Mai's philosophy. Even when seeking asymmetric opportunities, he carefully limits exposure. He sizes positions to control potential losses, uses hedges when appropriate, and always considers the worst-case scenario. By protecting the downside, he ensures that no single mistake can jeopardize long-term success. Another important aspect of Mai's approach is flexibility. Markets are constantly changing, and what appears to be an opportunity today may vanish tomorrow. He adapts quickly, revising positions and strategies as conditions evolve. This combination of preparation, adaptability, and focus on asymmetry allows him to generate exceptional results over time. Mai also emphasizes the psychological aspect of trading. He avoids letting fear or greed drive decisions. Instead, he maintains emotional discipline and focuses on the process rather than the outcome. By controlling his emotions, he is able to act rationally even in volatile markets. From Jamie Mai, we learn that trading is not just about predicting the future. It is about finding situations where the odds are stacked in your favor, managing risk carefully, and acting decisively when the opportunity arises. His philosophy teaches us that small, calculated moves can lead to extraordinary results when asymmetry exists. Having explored the strategies of Jamie Mai, we now turn to another multi-strategy trader who combines art and science with advanced risk management. Michael Platt demonstrates how disciplined risk control and systematic execution can amplify returns without increasing vulnerability. Let us now step into Chapter 8 and discover the insights of Michael Platt. Mastering the Art and Science of Risk Control. Chapter 8. Michael Platt. The Art and Science of Risk Control. Michael Platt is a trader who built his reputation on one core principle: control risk at all times. For him, trading is not about chasing big wins blindly. It is about maximizing returns while protecting capital from unexpected losses. Platt's philosophy shows that discipline, strategy, and preparation are more important than raw intelligence or luck. Platt emphasizes that risk is everywhere in the markets. Even the most promising trade can turn against you in an instant. He treats risk as something measurable, manageable, and always to be respected. Every decision involves weighing potential gains against potential losses. No trade is taken lightly. Every scenario is considered, and every position has a limit. His approach combines mathematics, data analysis, and human judgment. Platt uses quantitative models to estimate probabilities and potential outcomes. But he does not blindly follow formulas. Markets are dynamic, and human behavior is unpredictable. Platt balances statistical insight with intuition, adjusting strategies as conditions change. Another key lesson from Platt is diversification. He spreads risk across multiple instruments, strategies, and markets. If one position underperforms, others can offset the loss. This approach reduces vulnerability and allows consistent performance over time. He also emphasizes the importance of monitoring positions continuously. Markets can shift in moments, and staying alert is critical to managing exposure. Platt's philosophy also stresses adaptability. He constantly reviews past trades to learn what worked and what did not. By analyzing both successes and failures, he refines his strategies and improves decision-making. He sees trading as a continuous process of learning, testing, and optimizing. Discipline and emotional control are central to Platt's approach. He does not let fear or greed dictate decisions. Even in volatile markets, he remains calm, methodical, and patient. By focusing on process rather than outcomes, he maintains clarity and avoids impulsive mistakes. From Michael Platt, we learn that success is not about being right all the time. It is about controlling the things you can control, managing risk carefully, and making consistent, disciplined decisions. By respecting the power of risk, traders can survive the inevitable setbacks and compound their gains over time. Having studied Platt's approach, we now turn to Steve Clark. Clark exemplifies another principle of multi-strategy trading. Focus on what works and minimize what does not. He shows that disciplined execution and continuous evaluation of strategies can generate superior returns without unnecessary complexity. Let us now step into Chapter 9 and explore Steve Clark, doing more of what works and less of what does not. Chapter 9. Steve Clark. Do more of what works and less of what doesn't. Steve Clark is a multi-strategy trader who focuses on simplicity, discipline, and efficiency. He believes that success in markets is less about chasing every opportunity and more about doing the right things consistently. For Clark, trading is about maximizing strengths and minimizing mistakes. He emphasizes that every trader has a core skill set, and leveraging it repeatedly leads to superior results. Clark's approach begins with careful observation. He studies his own past trades, analyzing which strategies deliver consistent returns and which tend to fail. Instead of trying to be right on every trade, he focuses on repeating actions that have proven effective. By doing more of what works, he compounds gains steadily. By doing less of what does not, he avoids unnecessary losses. A key lesson from Clark is the importance of metrics. He tracks performance rigorously, keeping records of trades, success rates, and outcomes. Data-driven evaluation allows him to separate luck from skill and to refine strategies over time. This discipline ensures that decisions are based on evidence rather than intuition alone. Clark also emphasizes risk control. Even when executing trades that work well, he monitors exposure closely. Position sizing, stop losses, and diversification are all part of his methodology. He understands that consistent performance is built not by big wins alone, but by preserving capital and managing volatility. Another defining feature of Clark's style is adaptability. Markets change constantly, and strategies that worked yesterday may fail tomorrow. By constantly evaluating results and adjusting approaches, he maintains an edge. He treats trading as a dynamic process, where continuous improvement is more valuable than perfection. Clark's philosophy extends beyond technical skill to mindset. He values patience, focus, and self-awareness. Emotional discipline prevents impulsive decisions and ensures that logic and data guide trades. He avoids overconfidence, acknowledging that even successful strategies require careful monitoring and periodic adjustments. From Steve Clark, we learn that trading is not about complexity or chasing every opportunity. It is about understanding your strengths, measuring results, managing risk, and repeating what works. Consistency, discipline, and humility create an advantage that lasts over decades. Having explored the lessons from Part 2, multi-strategy players, we now turn to a different approach: equity trading. Equity traders focus on companies, industries, and valuation. They analyze fundamentals, identify undervalued opportunities, and invest with a longer-term perspective. Part 3, Equity Traders, begins with Joel Greenblatt, a legendary value investor who shows us the power of discipline and process in equity markets. Let us now step into Chapter 10 and meet Joel Greenblatt. Discovering the value of discipline in investing. Part 3. Equity traders. While the first two parts focused on macro and multi-strategy trading, Part 3 turns our attention to equity traders. Equity trading is the art and science of investing in individual companies. Unlike macro traders who analyze global economies or multi-strategy traders who balance multiple approaches, equity traders dig deep into business fundamentals, seeking opportunities where value is mispriced or growth is overlooked. Equity trading demands patience, discipline, and a strong process. It is not about quick wins or chasing market momentum. Success comes from thorough research, careful analysis, and the ability to remain focused even when markets are volatile. Equity traders must understand industries, management teams, financial statements, and competitive dynamics. They also need the emotional resilience to stick to their strategy when others act irrationally. A hallmark of great equity traders is discipline. They follow a structured process to identify, evaluate, and execute trades. They avoid impulsive decisions, relying on careful analysis rather than market noise. They understand that opportunities are rare, and when they appear, they must act decisively. Another key element is long-term perspective. Equity trading often involves holding positions for months or even years. Patience allows value to be recognized by the market and for investments to grow. It also requires confidence in one's research, as short-term fluctuations can be misleading. In this part, we explore equity traders who have excelled through discipline, process, and independent thinking. They teach us that understanding the business behind the stock is just as important as understanding the market itself. They demonstrate how careful analysis, combined with emotional control and strategic patience, can lead to exceptional long-term returns. Our journey in equity trading begins with Joel Greenblatt, a legendary investor who has mastered the value investing process. Greenblatt shows us how discipline, formulas, and systematic evaluation can uncover undervalued opportunities and generate consistent success over time. Let us now step into Chapter 10 and learn from Joel Greenblatt. Discovering the value of discipline in investing. Chapter 10. Joel Greenblatt, The Value of Discipline. Joel Greenblatt is a legendary equity investor known for his disciplined approach to value investing. He believes that consistent success in investing comes not from intuition or luck, but from following a systematic process. For Greenblatt, discipline is the foundation of long-term wealth creation. It allows investors to separate emotion from analysis and to act rationally even in turbulent markets. Greenblatt's method begins with valuation. He seeks companies whose intrinsic value exceeds their market price. To identify these opportunities, he developed formulas that combine earnings yield and return on capital. These metrics provide a clear, objective way to measure whether a stock is cheap relative to its potential. By following this method, Greenblatt removes much of the guesswork and emotional bias that plagues many investors. Another key aspect of Greenblatt's philosophy is patience. Markets do not always recognize value immediately. Prices can fluctuate, sometimes significantly, before aligning with a company's fundamentals. A disciplined investor must have the patience to hold positions until the market catches up. Short-term volatility is ignored, and attention is focused on long-term results. Greenblatt also emphasizes simplicity. He avoids unnecessary complexity and relies on clear principles that can be consistently applied. His process is repeatable, transparent, and adaptable to different market conditions. By keeping things simple, he reduces mistakes and ensures that decisions are based on evidence rather than speculation. Emotional control is another cornerstone of his approach. Investors often fall prey to fear and greed, buying when markets are high and selling when panic strikes. Greenblatt teaches that these reactions are dangerous. Discipline and adherence to process help investors remain calm and rational, even when markets are chaotic. This psychological edge is often as important as analytical skill. From Greenblatt, we learn that success in equity investing is about doing a few things very well. It is about valuing companies accurately, acting systematically, and resisting the temptation to chase trends. Discipline turns a simple process into a powerful tool for consistent returns. Having explored Greenblatt's method, we now turn to another equity trader who highlights the importance of process, Lee Ainsley. Ainsley demonstrates how structured strategies, continuous evaluation, and disciplined execution allow investors to thrive in highly competitive markets. Let us now step into Chapter 11 and uncover the insights of Lee Ainsley. Understanding the importance of process in equity trading. Chapter 11. Lee Ainsley. The importance of process. Lee Ainsley is an equity trader who demonstrates that success is rarely about talent alone. It is about process. He believes that a disciplined, repeatable approach to investing is far more valuable than sporadic brilliance. By focusing on process, Ainsley reduces errors, manages risk, and positions himself to capture long-term opportunities. For Ainsley, process begins with research. He studies companies thoroughly, analyzing financial statements, management quality, and industry trends. He does not make decisions based on rumors, market hype, or short-term price movements. Instead, he relies on systematic evaluation to identify companies with sustainable advantages and undervalued potential. Another key aspect of his approach is adaptability within a structured framework. Markets change and opportunities evolve, but Ainsley maintains a consistent method for analyzing and executing trades. This allows him to adjust to new information without abandoning the principles that guide his investment philosophy. He compares investing to building a machine. Each part has a function, and the system works reliably when all components operate according to design. Risk control is also central to Ainsley's process. He understands that even the best ideas can fail. Position sizing, diversification, and careful monitoring of exposure help protect capital. By limiting losses on individual trades, he preserves the ability to invest successfully over the long term. Ainsley emphasizes patience and discipline. Equity investing is not about chasing trends or reacting to daily market fluctuations. It is about waiting for opportunities that meet strict criteria and executing them with confidence. Emotional control ensures that fear and greed do not interfere with decision-making. He views patience not as a passive trait, but as an active strategy that allows value to emerge. Another lesson from Ainsley is continuous learning. He reviews past trades to understand successes and mistakes. This reflection allows him to improve process over time, making his strategy stronger and more resilient. By treating investing as a discipline rather than a guessing game, he consistently gains an edge over less systematic participants. From Lee Ainsley, we learn that process is the backbone of success. It ensures consistency, reduces errors, and allows disciplined decision-making even in unpredictable markets. By following a structured approach, investors can harness skill, intelligence, and patience to achieve exceptional results. Having studied Ainsley's disciplined approach, we now turn to a contrarian equity trader, Kirill Sokolov. Sokolov shows the power of thinking independently, going against the crowd, and exploiting behavioral biases in the market. Let us now step into Chapter 12 and explore Kirill Sokolov, learning the art of thinking against the crowd. Chapter 12. Kirill Sokolov. Thinking against the crowd. Kirill Sokolov is an equity trader who built his success by thinking differently. While many investors follow trends, Sokolov thrives by going against the crowd. He understands that markets are often driven by fear, greed, and herd behavior, which can create mispriced opportunities. By observing how others react emotionally, he identifies where value is hidden and acts decisively when the majority is wrong. Sokolov's approach begins with independent research. He does not rely on popular analysts or mainstream opinions. Instead, he digs deep into financial statements, industry dynamics, and company fundamentals. He asks questions others overlook and challenges conventional wisdom. This contrarian perspective allows him to spot undervalued companies that the market has ignored or misunderstood. Another key aspect of Sokolov's strategy is patience. Contrarian opportunities often take time to materialize. The market may remain irrational for weeks, months, or even years. Sokolov waits calmly, trusting that sound analysis will eventually be rewarded. He understands that temporary setbacks are part of the process and does not let short-term volatility affect long-term decisions. Risk management is central to his philosophy. Thinking against the crowd can be uncomfortable and sometimes costly in the short term. Sokolov carefully sizes positions, sets limits, and ensures that no single contrarian bet can jeopardize his overall portfolio. By controlling risk, he maintains the freedom to take opportunities others avoid. Emotional discipline is another crucial element. It is psychologically challenging to act differently from the majority. Fear of being wrong or missing out can tempt investors to follow the herd. Sokolov trains himself to remain calm, focused, and committed to his independent analysis. He embraces discomfort as a signal that he is likely doing something the majority is not. Sokolov also emphasizes the value of continuous learning. He studies market behavior, investor psychology, and historical patterns. This knowledge helps him anticipate reactions, avoid common traps, and refine his contrarian approach. He understands that success is not about being contrary for its own sake, but about applying independent thinking to find real opportunities. From Kirill Sokolov, we learn that independent thinking and emotional discipline can create significant advantages. Markets are not always rational, and those who see what others overlook can achieve remarkable results. Patience, research, and courage are the hallmarks of a successful contrarian investor. Having explored equity trading, we now shift to a different type of market entirely: commodities. Commodity trading requires a deep understanding of supply, demand, and global dynamics. It is often fast-paced, unpredictable, and highly sensitive to external events. Part 4, A Commodity Trader, introduces Kevin Daly, who mastered the complexities of this market and demonstrates how to pull the right levers at the right time. Let us now step into Chapter 13 and uncover the insights of Kevin Daly, Mastering the Forces Behind Commodity Trading. Part 4, A Commodity Trader. While equity trading focuses on companies and macro trading looks at entire economies, commodities offer a different challenge. Commodity markets are fast, volatile, and highly sensitive to global events, weather patterns, political developments, and economic shifts. Success in this arena requires not just analysis, but intuition, timing, and an understanding of the forces that move supply and demand. Commodity traders must think differently. Unlike stock traders, they cannot rely solely on fundamentals like earnings reports. Instead, they watch global production, inventory levels, shipping trends, and geopolitical tensions. They also monitor market sentiment and speculation, because prices can swing dramatically, even on rumors or expectations. Risk management is even more critical in commodities. Leverage is common, and small miscalculations can result in large losses. A successful commodity trader must protect capital rigorously, set clear limits, and prepare for sudden shifts in market dynamics. They balance aggression with caution, seeking opportunity while always respecting the power of volatility. Part 4 introduces Kevin Daly, a trader who mastered this complex environment. Daly's approach combines keen observation, data analysis, and strategic timing. He studies who is moving the market and why, identifying the forces behind price swings. By understanding these levers, he positions himself to capture profitable opportunities while minimizing risk. Daly's story teaches that commodity trading is both science and art. It requires analyzing numbers and charts, but also sensing the rhythm of the market and anticipating human reactions. Success comes from preparation, discipline, and adaptability, not just luck. As we move into Chapter 13, we will see how Kevin Daly navigates this high-stakes world. He shows us the importance of understanding the underlying drivers of market movements, applying risk management rigorously, and executing with precision. Let us now step into Chapter 13 and learn from Kevin Daly, who is pulling the levers in commodity markets and how he profits from understanding them. Chapter 13, Kevin Daly, who is pulling the levers. Kevin Daly is a commodity trader who thrives on understanding the forces behind market movements. For Daly, success comes not from guessing price direction blindly, but from identifying who is influencing the market and why. He asks questions like, which players have the biggest positions? What news or events could change supply or demand? Who is buying or selling, and for what reasons? By answering these, he positions himself ahead of major market shifts. Daly's approach begins with observation. He monitors production data, inventories, weather patterns, shipping logistics, and political developments. He combines this with real-time market data and trading flows to form a clear picture of potential price movements. This allows him to anticipate imbalances before the crowd reacts. Another key lesson from Daly is timing. Knowing the drivers is not enough. Execution is crucial. Daly waits for the right moment to enter or exit positions, balancing patience with decisiveness. A well-timed trade can be far more profitable than one entered too early or too late. Risk management is central to his philosophy. Commodities are inherently volatile, and leverage magnifies potential gains and losses. Daly carefully sizes positions, sets stops, and prepares for adverse scenarios. He knows that preserving capital is essential to surviving the unpredictable swings of commodity markets. Daly also emphasizes learning from the market itself. Each move, each reaction, is data to be analyzed. By understanding patterns, behavior, and reactions over time, he refines his methods and improves decision-making. Mistakes are not failures. They are lessons that make his system stronger. Emotional discipline is critical. Commodity markets can be fast and stressful. Daly maintains composure, avoids impulsive reactions, and trusts his research and analysis. By combining observation, analysis, timing, and discipline, he navigates volatility successfully. From Kevin Daly, we learn that understanding the market's underlying forces is as important as analyzing numbers. Commodity trading demands observation, timing, risk control, and psychological resilience. By mastering these elements, Daly consistently captures opportunities others may miss. Having explored the world of commodity trading, we now shift to a different role in the investment ecosystem: fund of funds management. This involves overseeing multiple managers and strategies, selecting the best opportunities, and mitigating risk across portfolios. Part 5, Fund of Funds Manager, introduces Anthony Scaramucci, who demonstrates how to excel in this unique area of finance. Let us now step into Chapter 14 and learn from Anthony Scaramucci, Wall Street's salesman and fund of funds strategist. Part 5, Fund of Funds Manager. After exploring macro markets, multi-strategy players, equity investing, and commodity trading, we now enter a different world, the realm of fund of funds management. This is a world where the trader's skill extends beyond individual trades or strategies. A fund of funds manager evaluates, selects, and oversees multiple investment managers and strategies, building a portfolio that balances risk and reward across many layers. Success in this domain requires vision, analytical skill, and people insight. Unlike single strategy traders, a fund of funds manager must understand not only markets, but also the abilities, style, and temperament of the managers they allocate capital to. They must assess performance, gauge potential, and anticipate risks across portfolios they do not control directly. Risk management takes on a new dimension here. Because exposure is multiplied through multiple managers, small errors can compound if not monitored closely. A fund of funds manager must diversify thoughtfully, allocate capital strategically, and maintain flexibility to adapt to changing market conditions. Communication and persuasion are equally critical. Managers must not only select investments, but also maintain relationships, negotiate terms, and align incentives. This requires a combination of financial acumen, strategic thinking, and interpersonal skill. In Part 5, we meet Anthony Scaramucci, a trader and entrepreneur who mastered this complex environment. Known for his bold personality and Wall Street experience, Scaramucci demonstrates how fund of funds management blends strategy, analysis, and networking. He shows that overseeing multiple managers is not simply about numbers. It is about understanding people, markets, and risk on a macro and micro level. Scaramucci's story teaches that in finance, success can come not only from trading skill, but also from vision, coordination, and the ability to manage complexity. By combining careful analysis with intuition, relationships, and decisive action, A fund of funds manager can generate significant returns while managing the risks inherent in layered portfolios. As we move into Chapter 14, we will explore how Anthony Scaramucci navigates this intricate world. He shows us the art of selecting managers, structuring portfolios, and building a system that delivers consistent results. Let us now step into Chapter 14 and learn from Anthony Scaramucci, Wall Street's salesman and master of funds strategy. Chapter 14. Anthony Scaramucci, Wall Street's salesman. Anthony Scaramucci is a fund of funds manager who built his career on vision, strategy, and communication. Unlike traders who focus on individual securities or markets, Scaramucci's skill lies in selecting and managing multiple investment managers and strategies. He acts as a bridge between capital and talent, ensuring that the best opportunities are harnessed while risks are controlled. At the core of Scaramucci's approach is due diligence. He evaluates managers carefully, analyzing performance, methodology, and discipline. He asks questions others might overlook. How does this manager make decisions under pressure? What is their process for managing risk? How do they handle mistakes or unexpected market events? By understanding both the strategy and the person behind it, he minimizes surprises and maximizes potential returns. Scaramucci also emphasizes portfolio construction. It is not enough to select talented managers. Capital must be allocated thoughtfully. He balances strategies with differing risk profiles, time horizons, and market exposures. This diversification reduces vulnerability while maintaining the potential for strong returns. Communication and relationship management are vital. Scaramucci maintains close ties with the managers he oversees. He negotiates terms, sets expectations, and ensures alignment between incentives and performance. By fostering trust and transparency, he creates a system in which both investors and managers can thrive. Another key aspect of Scaramucci's philosophy is adaptability. Markets and strategies evolve, and successful fund of funds managers adjust accordingly. He continuously monitors performance, reassesses allocations, and rebalances portfolios when necessary. Flexibility allows him to respond to changing conditions without compromising discipline. Risk control remains central. Even the best managers can underperform or experience losses. By monitoring exposure, limiting concentration, and maintaining reserves, Scaramucci ensures that no single failure can derail the overall portfolio. This vigilance allows him to capture opportunities while protecting capital from unexpected shocks. From Anthony Scaramucci, we learn that managing complexity is as important as mastering markets. Success comes from combining analysis, selection, risk management, and communication. It is about leveraging the skill of others while maintaining oversight and control. His story demonstrates that finance is not only about trading ideas, but also about orchestrating talent, strategies, and resources effectively. Having explored the unique role of a fund of funds manager, we now move to Part 6, Conclusion. Here, we reflect on the lessons learned from all the traders we have studied. From macro visionaries to multi-strategy innovators, equity specialists, commodity experts, and fund of funds managers, each has a distinct approach, yet all share principles of discipline, risk management, adaptability, and continuous learning. Let us now step into Part 6 and discover the timeless lessons of the market wizards. Part 6, Conclusion. As we reach the final section of Hedge Fund Market Wizards, it is time to reflect on the wisdom and strategies of the extraordinary traders we have studied. From macro men navigating global economies to multi-strategy players balancing diverse approaches. From equity traders analyzing businesses to commodity experts timing volatile markets. And finally, to fund of funds managers orchestrating multiple managers. Each offers lessons that transcend their individual markets. While their methods differ, a few core principles unite them all. Discipline, risk management, patience, adaptability, and continuous learning are recurring themes. Every trader, regardless of strategy, understands the importance of preparation, process, and emotional control. They embrace uncertainty, respect probabilities, and avoid overconfidence. Even the most brilliant strategies fail without proper execution, risk oversight, and psychological resilience. This final part is not just a summary of strategies, but a reflection on mindset. The market wizards teach that consistent success in trading is not about guessing the future or predicting every move. It is about understanding the environment, leveraging knowledge, managing risk, and acting decisively when the odds are in your favor. They show that preparation and process often outweigh intuition and luck. In this conclusion, we will extract the key lessons from all the traders featured in this book. These lessons serve as guiding principles for anyone seeking to navigate financial markets with skill and discipline. They are insights that apply not only to trading, but to decision-making, risk-taking, and personal growth in any high-stakes environment. Having explored the journeys, strategies, and mindsets of these legendary traders, we now turn to the distilled wisdom they collectively offer. The next chapter, Chapter 15, Market Wizards Lessons, encapsulates these timeless lessons. It highlights the practices, principles, and attitudes that separate exceptional traders from the rest, providing a roadmap for anyone aspiring to excel in markets or any competitive field. Let us now step into Chapter 15 and uncover the enduring lessons of the market wizards, a culmination of decades of experience, discipline, and insight. Chapter 15, Market Wizards Lessons. The final chapter distills the wisdom of the market wizards into actionable lessons. Across different markets, strategies, and personalities, several common threads emerge. These are the principles that separate exceptional traders from the average, and that can guide anyone navigating uncertainty, risk, or competition. The first lesson is discipline. Every market wizard emphasizes the importance of sticking to a process. Whether it is Joel Greenblatt following valuation formulas, Jamie Mai seeking asymmetric opportunities, or Michael Platt managing risk, discipline ensures consistency. It prevents emotional decisions driven by fear or greed and allows traders to execute their strategies reliably. The second lesson is risk management. No matter how brilliant the trade, risk must be understood and controlled. Kevin Daly monitors positions and understands who is moving the market. Anthony Scaramucci diversifies across managers. Platt balances upside potential with downside protection. Preserving capital is as important as generating profits because survival allows for compounding and future opportunities. Patience is another universal principle. Opportunities do not arrive on schedule. Sokolov waits for the crowd to overreact. Greenblatt holds undervalued stocks until the market recognizes their worth. Ainsley executes strategies with careful timing. Patience allows the odds to play out in one's favor and avoids costly overreactions. Continuous learning is central. All market wizards review their mistakes, analyze outcomes, and refine methods. They treat trading as a lifelong learning process. Even when successful, they do not become complacent. Markets evolve, and adaptability is crucial for ongoing success. Independence of thought separates great traders from the herd. Sokolov thinks against the crowd. Mai searches for unique asymmetric opportunities. Ainsley follows process rather than noise. By maintaining intellectual independence, they identify value where others see risk and risk where others see opportunity. Emotional control ties all lessons together. Fear, greed, overconfidence, and impatience are common enemies. Traders who manage emotions effectively make rational decisions, stick to process, and act decisively when it matters most. Even in volatile markets, emotional discipline ensures consistency and clarity. Finally, the market wizards teach that success is personal and process-driven. There is no single path, no perfect formula, no guaranteed shortcut. Each trader develops a style suited to their skills, temperament, and strengths. The commonality is not a strategy, but a mindset. Preparation, discipline, risk awareness, patience, learning, and emotional mastery. From macro visionaries to fund of funds managers, the lessons are clear. Understand your market. Control risk. Trust your process. Learn continuously. Think independently. Manage your emotions. By applying these principles, traders and investors can navigate uncertainty, capitalize on opportunities, and achieve consistent long-term success. The wisdom of the market wizards extends beyond finance. It applies to any high-stakes field where decision-making, risk, and strategy intersect. Their experiences offer a roadmap for anyone seeking to master complexity, embrace discipline, and excel in competitive environments. As we close this journey through the Hedge Fund Market Wizards, we are left with timeless insights. Discipline, process, patience, and emotional mastery are the true engines of success. These lessons are not only for traders, they are for anyone striving to excel, overcome challenges, and achieve extraordinary results in life. Thank you for joining us on this journey through Hedge Fund Market Wizards. We explored the strategies, mindsets, and lessons of some of the most extraordinary traders in the world. From macro visionaries to equity specialists, commodity experts, and fund of funds managers, their wisdom offers guidance not only for trading, but for making disciplined, strategic decisions in life. If you enjoyed this summary and want more insights from the world of finance, investing, and trading, make sure to subscribe to our channel. Hit the bell icon so you never miss an update. Your support helps us bring more in-depth, audiobook-style content to you, keeping the lessons of the world's top investors just a click away. Stay curious, stay disciplined, and keep learning. The markets, and life itself, reward those who prepare, adapt, and act wisely. Subscribe now and continue your journey with us.